My name is Tanner Frigaard, born and raised here in Vegas, second generation. So my mom was born and raised here as well. My grandfather actually worked at the chemical plants over in Henderson back in the day. If you guys were around that time, one of them blew up. That was one of his. Thankfully, nobody was injured. But yes, it was many, many, many moons ago. But it's just phenomenal to see this town grow as big as it has. I've always been an entrepreneur and I've always loved business, which is kind of how I found myself in finance, to be real honest. I started my first little business when I was 8 and just kind of rolled through. So we maximized every effort. I was thankful and lucky enough to be homeschooled back before it was cool. You know, where I was the weird kid. They're like, why aren't they going somewhere? But I used to go everywhere, hiking to go do my math, you name it. I had figured out very creative ways. And I would start little businesses on the side as well. So I was able to kind of snowball that through. And eventually, by the time I turned 18, I moved out of my parents' house. I had enough money saved that I purchased my first home. And then me and my brother purchased a home at 20 when I was 22. And then we started building a rental portfolio, right? And we had 3 homes here in Vegas. Still have some of those still functioning. We actually sold a few of those, and now I'm branching more into the commercial spaces. A lot more lucrative industry, if you know, and some of those areas. So those are a lot of the stuff that I bounce back and forth with Oleg, and I go, hey, here's the situation. I'm using this. How do I maximize it all? I have some stocks, I have some bonds, I have, real estate portfolio. How is this going to affect? What do I want to do? And all of those things, I started having questions on at an early age, but I didn't have the resources like I do now to be able to call somebody and say, hey, I'm just really curious about this. Right? And now I'm thankful enough that my brother is a CPA, so I can ask some questions on the accounting sides. But as far as like investments and finance, I was always kind of left in the dark. So I always saw a little bit of an opportunity of where you can find a need and you can find a way to fulfill that need. All you need to do is put yourself in the middle of it, and all of a sudden you have a business. Right? And that's really how it all started. I've been now licensed in the industry going on 10 years. So it's been super rewarding, and being able to help actually educate people, not just tell them what to do, but allowing them to tell me what it is they're looking to do, and then helping them navigate the world of finance to get that outcome. And that's really what we wanted to do here tonight. So appreciate you guys all being able to make it, and we're going to dive right in. So first thing is first. Let me grab this clicker.
If you guys haven't picked up on the dynamic yet, Tanner's the energy, I'm the cool and collected.
Yes, so I am very hyperactive knucklehead. That was my nickname, was Tanner Calm Down. So feel free.
Tanner, why don't you, I'll introduce myself.
Yeah.
We'll give Tanner a little breathing break. My name is Oleg Zviagin. I'm the founder of Elevate Planners, a registered investment advisory firm. For those of you that aren't familiar with the various tiers and the various types of people that call themselves financial advisors, I am the one that is allowed to call myself a fiduciary, which means that I am obligated, for all intents and purposes, to give you advice that is only in your best interest without any conflicts of interest on my own. I've been in the industry for about 13 years now, working exclusively in the registered investment advisory space. So I've worked with clients ranging from just starting out their career fresh out of college all the way through multi-generational planning, building legacies, and thinking about how to pass along inheritances. I am originally from New York. I'm a first-generation immigrant, and one of the things I've experienced when I was growing up was all of the different ways finances goes wrong. And I'm sure any of you that experienced finances in the 80s and 90s know what a messy industry it used to be. And that is why nowadays we have these things called fiduciaries and why we have RIAs. And it's my goal to make sure that finance isn't this three-headed monster. It needs to be understood, it needs to be felt, and there needs to be comfort with it, which is what Tanner and I are looking to bring to this room to make sure that everything is clear and that you don't need to understand every concept we talk about. But what I've learned is if you can even pick up one thing that may be of interest or of value to you, I promise to you there will be a second.
Awesome. So let's dive right on in. So who is PWYB? That stands for Protect What You Built. That is a mission statement that I have always held in my heart because I love when people build something, but then often they don't know how to always make sure that they're protecting it and making sure that whatever life could happen, right, quote unquote, you still are able to retain and maintain. So we offer specialized wealth management insurance solutions. Financial strategies focuses on securing assets and long-term financial security. So that's really what our mission is about and what it is that we're trying to focus on. So personalized wealth protection, privacy-focused solutions, long-term focused strategies. So we're thinking more than just a 5-10-year timeline, but how is this going to affect us when we're 30, 40 years from now, or in the event we're generationally passing on different avenues, which could happen at any moment, right? And making sure that those things are appropriately set up now, because it's hard to go back. It's just like when we get in a car accident, how we find out how much insurance we wish we would have had. You know, if we could go back in time, we would, right? And that's what we wanted today to kind of be about, is making sure you guys know how to maximize it. So really our full transparency is we believe in an honest communication. We want to keep you up to date of what's happening as we're going through the process, as we're moving money or setting up a plan. That we understand that things can come up, and oftentimes one of the biggest issues in our industry that me and Oleg know very well is the number one complaint is people can't get a hold of their advisor, right? And making sure they don't know what's going on, when is it happening, et cetera. We want to make sure that those things are accessible. And so that's really where the transparency for us comes in. So to dive in a little further, and why wealth preservation matters. So your wealth, I believe, I'm sure I'll probably get 100% attendance if I ask anybody if they believe that they work hard for their money or have at some point, right? And what we want to do is making sure that, well, what happens in the event that now somebody else is coming at it, right? So we all know lawsuits and different things, right? And so maybe you've heard of this thing called the three-legged stool. I know I'm sitting on a four-legged stool, but if anybody heard the concept of a three-legged stool, this is what people used to be able to depend on to retire. And that was Social Security, pension, and personal savings, right? And so as we look through what's happening through a lot of the work environments today, is there's not a whole lot of pensions being offered, right? They have supplemental, some things, you know, adding in 401ks and different things, which we'll get into. But then we have the Social Security aspect. And then there's some concerns with that and what's going on in those avenues. So then really, where does that leave people? With personal savings, standing on one single leg, right? And so that can feel a little stressful in times. And so we want to help making sure that that stool you're standing on isn't just trying to balance on one leg, right? And so that's where securing this legacy ultimately really matters for the future. So what are some of the tax saving strategies that people are aware of? They know the business deductions, and we can get into a few of those, but I don't want to bore you with too many of those details. And then we also know about the mortgage interests, right? But what are some other things? So what are some more complex strategies like 401ks, which are tax deferred? And all that way, all tax deferred, and just so I don't speak too much of a different language in case you're unfamiliar with some of these terms, is that's a now, this year, save me money. I put money here means that I deducted on the taxes as far as how much income I made. And so it essentially balances out, and you can use it at a later time. Okay? And then when you take it out, it's its own avenue of how you receive those incomes, but that's its own area. Then we got those IRAs, right? A lot of times people are maximizing IRAs on their own personal deductions because you can, right? If you don't own a business, there's very few tax deductions that are still available for us, right? And so having an IRA is an excellent option for some of those who just need a little bit over that hump, right? They're taking a little bit too much extra income or something along those lines, made too much. They can offset on some of the personal sides. And then there's the charitable gifting, right? If you're not maximizing this avenue, I fully want to encourage you to, right? That could be through, different types of opportunities. You can gift money into people that you care and like. There's all kinds of creative ways that you can go about that. But charitable gifting is a huge advantage that you could leverage. So here's some of the things that you may know and some of the things you may not. Executive bonus plans. I'm going to show you this a little bit more in a concept, but has anybody here heard of the terminology infinite banking? Much? Okay, a couple of us. Great. So we're going to talk a little bit about what does that mean and how does that work. And this is kind of more of a complex structure that's more of a personalized pension plan that you can set up as a business owner for a key executive that doesn't have the ERISA guidelines. And what the ERISA guidelines are is everybody has equality, right? And I'm not against that. But what if you wanted to be able to bonus out somebody a little extra that year, but not everybody else have it? Right? That's where ERISA says, no, you got to follow these specific guidelines and rules. Well, with you don't have those holdings, right? You can kind of create and structure something that's going to be a little bit more lucrative for the company and the individual receiving those benefits. And so I'm going to show you how that concept works in a more complete functionality as well. But then we have the tax-deferred annuities, life insurance, that there's so many opportunities there on. And then we have the tax-deferred self-employed and I can't speak today. Thank you. Practitioner. Thank you. The retirement contributions, right? We have our tax-free Roth contributions and growth. And then we have our tax-free, tax-preferred municipal bonds. Now, I know that some of you guys are maybe taking advantage of some of these structures. And if not, or if you haven't looked at it in a little while and you have some questions about what's coming up and what's going on, that's really where we wanted to make sure we're opening up those conversations for you to be able to make sure that we could review those things and make sure that you're maximizing all the areas you should. Right? And then we have the 529 contributions. There's a lot of, you might have heard of them as the college plans, right? For the futures. There's a lot of really great opportunities you could be leveraging for either yourself, grandkids, or kids, really, that you can maximize. And then we have the charitable gifts, right? Oleg, do you have anything else you would like to add on that? Sorry, I went through a lot.
No, we're going to cover a lot of these in the later slides.
Cool. So let's get into the executive bonus. I just wanted to handpick this one because it's one of my personal favorites because it's one of the less known. Now, I had an opportunity about 6 months ago. I sat down with an old executive from one of the casinos, and fortunately, he actually was taking advantage of this right now. So he worked for several of the properties here in Vegas, and when he ended up retiring, they actually had a policy for him already established. So what does that mean? They were setting aside money that the company got to take as a business tax deduction. And I'll show you how all that works. So that's where it's a tax deduction for the company. Now it does receive, the person receiving it, it is taxable to them. We'll get into that also in a second. But it really became a personalized pension for him. So as he's taking out the withdrawals, which is currently he's taking out $60,000 a month. So yes, $1 million a year, tax-free, actually is what he is withdrawing. Because he set this up, or his executives of the casino, they set it up for him as a personalized pension plan. So now he has a guaranteed income tax-free revenue stream for him and his family that's paying him $60,000 a month, completely tax-free. Doesn't affect Social Security, doesn't affect anything else. And he can reallocate it any way. He could take the distributions or not. But he knows he has that guaranteed monthly income set in stone for the next 15 years. He's now 3 years into the program, so now he only has 3 more left. Or, 3 less. So he's got 12 more left. But those are types of things that when we're thinking of how do we create something of retention is a big thing that I'm talking to a lot with business owners and having to constantly have that turnover, right? On average, a healthy turnover. Does anybody want to give a shout out of what their percentage is, what their think is a healthy turnover rate for a company in today's? Any ideas? No? 20%. And I got some old CPAs in the room. They can confirm on some of these for me. But 20% is what they consider a healthy turnover. Now, having to retrain and do all those things for employees can be extremely expensive, especially depending on the industry you're in, right? And so making sure that you have something set up, I call it golden handcuffs, because as the business owner, you can set some stipulations of when they have access, how much, all of the good things to make sure that you can retain them over a lengthy period of time. At the same time, if something happens prematurely, well, then you could utilize that to buy out the either investors or you could utilize it to have that tax-free death benefit goes into beneficiaries, charitable contributions, etc. Okay? So there is also the opportunity. You can immediately give it over 100% over to the employee and just going, you know what, you've already worked here for so long. I'm not going to require you to be vested. We're going to immediately start you with that. And it's an option, right? And so it's flexibility. There's flexible contributions. So as long as you want to contribute to it for them over a length of period of time, it's going to be advantageous for both parties, right? And I'll show you how that works as well. Does anybody have any questions on that? No? Excellent. So hopefully I explained it perfectly. So, okay, let's go through this real fast. So the employer pays the premiums, right? So the premium that goes into a life insurance company. So that would be like, Brooke, I'm going to use you as my example because we love American National. American National. So we set it up a policy with American National. American National now is receiving those premiums. And so in the event, one, worst case, absolute worst case, the only worst case scenario it can't get much worse than this is we die, right? Now what happens? Well, in the event that happens in the executive death, the cash value as well as the life insurance attached to that goes to the beneficiaries completely tax-free. Now let's talk a little less morbid. Let's say we're living, but maybe we developed a sickness, illness, or something happens throughout time, and we need a little bit more care. That's a little bit more costly. I don't know if you guys seen the cost of health insurance and going into those doctors and different things
We
recently.
have all seen it,
right? It becomes more expensive. So having an opportunity to have something such as living benefits, meaning if I had a terminal, critical, or chronic illness, what is that? A stroke, heart attack, cancer, something along those lines, having access to that death benefit while you're alive. It's a life benefit, not just a death benefit, right? But those also, if you're, let's say, pulling out those distributions as the executive, you're pulling them out tax-free. So yes, could you be the owner and the executor and pay this off? Yes, you can. You, as the owner of the company, could also benefit yourself as well as other key individuals, which is where it becomes a nice little tool of retention, right? It's selective. Now, the executive, as I mentioned, the person receiving the bonus, it's still taxable as income for them, right? And so what that means is they got to pay the IRS because the IRS always makes sure they get their cut, right? Although the options are for the employer to cover, it's called a gross up, where the business can actually cover the taxes for the individual as well. So let's put it in a brief concept is, let's say I needed to write off $100,000, okay? I'm going to bonus Oleg $70,000. I'll take the other $30,000 that he would have to pay in tax. Instead of him paying the tax, I'll cover that tax for him. The company, me, got a $100,000 tax deduction. Oleg got a $70,000 bonus that's going to grow tax-free. He has access to it when he wants, so it's not a 59.5 rule. You have to wait till retirement. You can actually pull out these funds sooner than that timeline, which is where infinite banking comes in. Because now I'm placing them in an insurance policy that, one, is not it mirrors the market, but it's not attached into the stock market. Meaning those ups and downs, you don't have that in these types of policies. It goes up, but the premiums can't go down unless you're taking a withdrawal or a loan out. So it allows you to consistently get a rate of return between 6 in some cases 10% on average. So when we're taking a look at what indexes do we leverage, it would be like the S&P 500. Right? And so you can take a look at the timelines of those. And the beautiful part is that's actually one of the accounts that's in American National. Why we love leveraging them as well is because they do use those types of indexes, right? So when the business is fully maximizing these benefits, I feel like it helps with retention. It takes care of the taxable issue for the company, as well as giving individual people that you just want to bonus, including potentially even yourself, more than what you could do traditionally through some of the other methods that we're also going to be discussing. Because this isn't to replace, this is to enhance what Oleg's going to be going through today. And that's where there's different tiers of where you want to maximize your benefits, right? And so this is just one. Now, just to leave you with one last tidbit, people ask all the time as far as like on contributions, what is max limits? And on an executive bonus, the maximum you can put in for a single individual per year would be up to $1 million. So could you put some sustainable, substantial capital in? Yes. Does it always make sense? No. There are some other factors such as age and health that do determine some of the costs associated, but those are all case-by-case basis. Okay? So now I'm going to have Oleg go into a little bit more of the fun things, which is some of the more complex solutions that you may be aware of or maybe haven't had the opportunity to fully dive in, and we want to make sure that you have those pieces of info now. So Oleg, take it away.
I don't know how fun this is going to be. We are going to be talking about taxes, one of the most hated things that our government has decided to attach to pretty much everything in our lives. We have sales taxes, income taxes, growth taxes, and eventually death taxes. But there's three things in life that are true, right? It's death taxes and two guys ranting at you on a stage. The most complex plans that exist really are the ones that we do know about. It's the 401ks. This really only pertains to the business owners who would be creating them or the employees that would be contributing to them. We're not going to cover that too much because, frankly, if you're a business owner or an employee, you likely already have access. If you do not, it is definitely something to consider. What I want to talk about is more of the individual side, because taxes and our system isn't built to be understood. It's not made for us to win. It's made to be played like a game. The reason that we have all of these different types of accounts is, it's to create a little bit of confusion. But the reality is that each of these vehicles is applicable to each scenario. One area that I really want to talk about, because I think it really does benefit you, regardless of what stage of life you are in, is the Roth IRAs. Just a quick show of hands, how many people here are familiar with Roth IRAs? Okay, half the room. Good, which means that the other half of you are going to learn some fun facts. Roth IRAs, especially after 2021, when the Secure Act went into place, the rules were changed. So there are two types of qualified accounts, let's call them. There's is my mic dead?
Yeah, here, I'm going to just swap you.
I could just talk louder. Can you hear me? Yeah. Okay, perfect. There are two types of qualified accounts. There's the traditional qualified accounts, which is pretty much every vehicle here except for the Roth IRA. And I'll just talk loud. What that means to you as individuals is you make a contribution while you're employed during your lifetime. You save the taxes on the contributions, and then eventually when you retire, when you need that supplemental income and you start withdrawing from it, it becomes taxable to you then. The gamble that you're making is that in the time period when you made the contributions, your tax brackets were higher than they would be when you retire. That's the bet. So the taxes are almost guaranteed, and you are required to start withdrawing from them at age 73 to 75, depending on when you turn those ages and when you start. Eventually, everyone will be 75. And the taxes that come out of it are formulaic. You are required to take out a certain amount every year throughout the rest of your lifetime. Whereas Roth IRAs, the way that they differ is that you are contributing after-tax money. You've already paid the money, you're not really making a bet. And so when you make those contributions, that money grows tax-free and eventually is withdrawn tax-free. So I like to refer to Roth assets as monopoly money because, you make a withdrawal, you don't even have to consider what the implications of that means. But the great thing about this is, and what most people do not know, is that in the law changes of the Secure Act of 2021, the way that Roth IRAs and regular IRAs were inherited were changed. Before, I'm sure many of you have received IRAs from parents, grandparents, whatever the case. Those IRAs were distributed also over your lifetime, so they were fully spread out. Whereas now, any account that your beneficiaries stand to inherit have to be distributed over a 10-year period. What that means is, let's say you pass on $100,000 or whatever amount. Your beneficiary needs to withdraw $10,000 every year for 10 years and then liquidate the rest of that account by that point. So if they're still working, children, grandchildren, whatever the case may be, they are paying their maximum tax rate on that money. So let's assume just for a average, and somewhere between 25 and 30% is going to get haircut off of that of those assets. The beauty about the Roth IRAs is that when Roth IRAs are inherited, the money still needs to be distributed over a 10-year period, but the money is not taxed to your beneficiaries either. So by prepaying the taxes for your beneficiaries, by spreading the taxation piece throughout your lifetime rather than theirs, you're saving them roughly 30% of what it is they would potentially inherit. And that is incredibly powerful. We tend to consider this the last money that you would ever want to touch. And there are certain timelines for when you can utilize what's called a Roth conversion strategy of taking money out of one pocket, putting it into the other, and taking advantage of those changes in your tax brackets. The timeline, just to put it briefly, is any time that you, whether employed or retired, would not be receiving a high income. So let's say you're taking a sabbatical from work, you're not going to be working for a year, that's a great opportunity. Let's say you retire at 65, but you don't start taking Social Security until age 70. You have a 5-year window when you have the opportunity to have a lower tax rate, so a lower cost to you for a much more exponential benefit to your beneficiaries. Go to the next one. So we're briefly just going to run through some business strategies for business owners and some things to consider, some things that are often missed. The most important thing, as Tanner mentioned, is protecting the growth and the stability of your business. One of the things that is dangerous for employers, no matter what industry they're in, is that turnover rate. And what are the ways that you could protect yourself from that turnover, whether it means leaving or passing or anything in between? As Tanner discussed, executive bonus plans. I'm only really going to focus on the part of executive bonus plans that is the retention piece. The executive bonus plan, because it is not what is considered an ERISA qualified account, allows you to set the rules and set the standards in a way where you would not be able to otherwise. The flexibility that you have with establishing those plans allows you to set time frames, which means you are making contributions to the account. The account value is technically in the benefit of that employee, let's say a partner or a manager or a salesperson that you really just cannot do without. That doesn't mean that they have immediate access to that money. You get to create what's called a vesting schedule of when it is that they would actually gain access to it, and that is a way that you can incentivize your key partners and your key employees to stay for a longer period of time. Partnership buy-sell agreements. Two owners going on a business. What happens if one of them passes? Can the surviving owner maintain the business, or do they need that bandwidth, that extra person? Buy-sell agreements allow both partners flexibility and reliability that in the worst-case scenarios, the business would still continue to run, give them the cash flow to continue running as they would have, and float them through that period of crisis, as we put it. Financial wellness programs. Really all that means is if you have a 401k plan, you have an advisor on that 401k plan. Is that advisor actually giving you advice, or are they just there as a placeholder and a phone number? Are they giving your employees suggestions on how to better manage their money, how to better save? Do your executives know all of the opportunities that they have available? Usually financial wellness programs are relationship-based. It's not a cost to the employer. It's the value of the relationship being provided. Group health insurance, we won't get into that, though there are ways that small businesses, employees ranging from 1 to 5 that usually would have difficulty finding a group benefit plan, giving them some flexibility of how to provide a health insurance benefit in an environment where perhaps they would not be able to afford one or would not be able to qualify for one. And that's what the qualified HRA plans are. They're simply reimbursement plans. To briefly summarize, let's say you have 5 employees. You cannot qualify for a health insurance plan because 2 or 3 of those employees would not sign up for it. Let's say they have spouses or they go through the marketplace. This program allows you to reimburse them for not only marketplace insurance, but their spouse's insurance. So they could be on their spouse's insurance, but get the benefit of an additional tax-free income, so to speak, up to a certain amount that will provide for them a benefit as if you were offering the health insurance yourself. And finally, key man policy is really another way of protecting, that top salesperson, that necessary manager, or that director that you rely on. So some common missed strategies and maybe some misunderstanding of how taxation works in our country. There are deferral strategies, which means you're taking your income, you're putting it into account, you're not paying taxes on it, so you're saving and you're rolling over when that tax would be due to you. We've already discussed that. Tax avoidance. How do we not pay taxes at all, especially when it comes to things like our investments? One of the things Tanner mentioned earlier are municipal bonds. Many of you are familiar with treasuries, offered by the government, tax-free on the state level, offer you a consistent, let's call it currently 4% return. If you're in a high tax bracket, whether it's a spouse or individual business owner, and you're paying 30% on taxes, that tax still applies to all of your investments, and particularly the fixed income side. Whereas municipal bonds are preferable in environments where you are a high earner, but you still want that return. So municipal bonds are not taxable on a state or a federal level if they are offered through your state of residence. So think your schools, your roads, your water companies, your utilities, all of the things that will survive a recession. These are the most secure investments on the conservative side because they are the ones that will continue to run even if the cost of diapers goes up, if the cost of food goes up. These are the places that will continue to function and continue to provide a service. In order for you to invest it, they are offering you the benefit of a tax-free return. Why is that good, especially right now in a high interest rate environment? Let's say you're paying a 30% tax rate, you have a bond of 4%. That 4% isn't clean. You won't see all of that 4%, so that is not an income that you could entirely rely on. You will only see the net after tax return on that. But if a municipal bond is offering 3.5% tax-free, that number after that calculation becomes higher than what you would have paid on a treasury at your given income tax rate. So this is just another way for us to capitalize on your financial situation and recommend investments that are suitable to you specifically on a timeline that is catered to you. Diversification. This is very, very important. And this applies to, people in real estate, people that, have all of their assets in insurance even, or just in stocks, or just in bonds. In any given year, every asset class that exists, and there's about 12 of them, will have a different performance. Anyone that tells you they can predict how that specific asset will perform is trying to sell you something, to put it bluntly. Because no one has a crystal ball. The market works in different ways. The economy works in different ways. And so the goal for a suitable and a strong financial plan is to have investment in all different types of classes. That way, in a given year, you'll still be a winner. One of your asset classes will be the top performer. So it is important to make sure that you're not only thinking about your returns, you're looking at where those returns are coming from. Stocks are where you're going to find the most growth but the most risk. Real estate is where you're going to kind of be in the middle, though there is a lot of work that goes into real estate. Bonds are more flat, fixed, predictable, but boring. And then you have insurance and annuities that play around with different combinations of those to provide you a balance between the two. Nevertheless, you need to have access and investments inside all of those in order to maintain a healthy portfolio. And one of the biggest things that is often missed, regardless of what state you live in, is estate planning. This is one of those things that people often overlook because they believe that a will is enough. And unfortunately, in many places, that is not quite the case, especially if there's a lot of net worth that we're talking about. Even if you just own your home. We're talking about anywhere between $250,000 all the way through several million, depending on the value. If you only have a will, or worst case scenario, you don't have any estate planning, your assets and the inheritance that your beneficiaries would receive goes through what is called probate. Probate is varies state by state, but the bottom line for wherever you live is there will be a cost and there will be a delay. Not to mention that there will be stress on the behalf of your beneficiaries who then have to take over the work and the responsibility of making sure that all of that is processed in due time. Last wills and testaments provide a direction for where your inheritance will go, but it does not avoid probate, which is why we talk about complex trust structures. Many of you may have heard of what's called a revocable or a living trust. That is a entity that basically overlaps and replaces a last will and testament. Revocable trusts are the simplest form of trust. Their primary goal is to make sure that your beneficiaries do not have to pay probate costs, which just on average, on a minimum, will cost anywhere between $30,000 to $50,000 of the estate, but only cost $5,000 to set up. So that's an immediate savings. Not to mention, revocable trusts will distribute assets to your beneficiaries within a week, as opposed to sitting and waiting with courts and attorneys for anywhere between 6 months to 2 years. More complex estate planning really starts to kick in when you have a much higher net worth. Right now, after Trump's tax adjustments, our current estate tax exemption levels are at about $13 million for an individual. Let's call it $26 million for a couple. But that is only if you take advantage of those rates today, because as we've seen, every time there's a new administration, there's a substantial change somewhere. And a lot of the times, the estate laws are the ones that get fought over the most and the quickest. So we already know that by the end of 2025, as soon as January 2026 rolls around, those numbers will be cut in half back to their previous norms. So if you happen to fall within a net worth projection that would exceed, let's call it 12 million for a spouse, for a couple, or half of that for an individual, you will have estate planning concerns. Why are we concerned about estate taxes? Well, estate taxes are some of the most aggressively taxed rates in our country, roughly 40% on a federal level. If you live in a state like California, you could tack on another 10% there. Why would the government take money that we've already paid taxes on just because we're transferring it? The idea that we are looking to accomplish here is plan ahead, plan for the worst case scenario, which is, let's say there are no exemptions. Let's say every single dollar that passes is one that will be taxed. We can plan for that ahead of time, whether the laws change or not, as long as we see that you are projected to go towards that in that direction. There are many, many different complex trust structures. There are trust structures that allow high income producing properties, businesses to turn all of the income out of the estate, out of your name, and not subject to that taxation. There's gifting trusts that allow you to make discounted gifts to your beneficiaries while you are still alive, saving you on what that total will be. And there are trusts that simply allow you to pay all of the taxation on behalf of your future beneficiaries. All of these trusts will not be applicable to every single person, but there are scenarios where it would be vital to consider because the tax savings over the course of your lifetime and over the course of your beneficiary's lifetime is paramount. And finally, the biggest thing about trusts that isn't always understood is the protections that they create. Let's say your children inherit $1 million from you tomorrow in their name. That $1 million is susceptible to divorce, which are at all-time high rates. It's susceptible to creditors, lawsuits, bankruptcies, you name it. If it's in your personal account, they could come after it. But if you have your money in a revocable trust and that money goes to your beneficiaries in trust, it's as if there's a separate entity with a separate social security number that is protecting that money from all of those risks. There are no ways to bypass those risks so long as the protections of the trust and the rules of the trust are maintained. There's a lot of flexibility with how the trust can be created. You know, the access doesn't need to be limited. but these are protections that you cannot create for yourself, and your children and your beneficiaries cannot create for themselves. So it is a multi-generational benefit, both on the savings, but more importantly, the protections that is important to pretty much anyone in the room with assets that they would like to leave for their future beneficiaries. And just to briefly touch on the insurance side of it, there are insurance strategies that go alongside this, whether there are trusts involved or not. Insurance is not just to protect your dependents. It is not just to protect your income. Insurance can also be used to protect the taxes that you know you will owe once your assets are going to that next generation. I think that was our short Q&A. If anyone has any questions about any of the really complex topics we talked about, now would be a good time. Any questions, Noam? All right. Yeah. Oh, yes, please.
What's a gifting trust?
So there are several types of gifting trusts that exist. Even right now, without a trust, you are allowed to, as an individual, you are allowed to gift up to $17,000 a year to each beneficiary, to an unlimited amount of beneficiaries, without having to have that count against your gifting exemption. And also without having to file a gift tax return. What that means is, let's say, you have a certain amount of assets. You need to spend down those assets in order to not have to pay those estate taxes on your passing. One of the strategies of lowering your estate is not to spend it, it is to start gifting it. A gifting trust allows you to use that exemption in a way that will also afford your children and your beneficiaries the protections of the trust that I had just mentioned. So you're able to gift, let's say, $17,000 a year into a trust for a beneficiary, or two trusts for each beneficiary, and you don't have to worry about any clawbacks, any of taxes, or any extra filing requirements for that year. That's the most basic. There's a more complex version where, let's say, you have a property. It's a home, your children grew up in it, you no longer use it, or even if you do use it, but you want that home to stay in the family. You don't want that to be sold. It has sentimental value. You could wait until you pass, and let's say it's $1 million home, and that $1 million home, all 1 million of that counts towards your estate. If you were to use a particular type of trust and gift that property into the trust, you're able to take a reduction in that gifting amount. So just to throw an easy number out there, the average is, if you're using like a 10-year schedule of how long the gift will take, which really just means you need to survive the term of that gift, you can take a 20% reduction in what that gift is. So rather than that gift being valued at $1 million, you've now reduced it to about $800,000. So there's a $200,000 difference in what would have been counted towards your estate. And if you're already at risk of hitting those numbers and exceeding the exemption amount, you get to reduce your estate, even though the value of the gift has not changed. Yes, another question.
You just brought up having another house. I have another house in state in New York. Okay. And I live here, but I want my son will end up getting it when I die.
Yes.
But I would like to maybe give it to him now. Then? So is that like a gift tax?
Yes, so that's exactly the type of scenario that we should talk about. Because if you were to just write over the home from your name to his name, that's an official gift. That's over that annual amount, and there's a gift tax return that you need to file. Do you need to worry about that from a tax perspective on your passing? It depends. If your net worth is, let's say, over $10 million, maybe we do need to worry about that. If it's underneath that, then a gift could be made regardless. But there are slightly different considerations in how that gift should be made, why that gift should be made, and whether or not there would be tax implications to your son when the gift is made. So if there's, let's say, growth in the property, one of the ways to account for that is, one of the gifting structures, there's a calculation to be made on whether or not there would be taxes to begin with, but it's a little bit of a complex situation to just you have to look at all the pieces, essentially. You have to look at everything that is that fits into your financial life. We have to look into everything that might impact his financial life, and there are solutions there, but perhaps gifting today isn't the best scenario. There's different avenues of approach, but yes, that would be one of the strategies if estate taxes are a specific concern to you and your household.
Sell it for like $100.
No. You wouldn't really be able to do that. There's some rules surrounding, depreciating the value of a property and things like that. Exchanging property really only matters as far as how much you purchased it for, how much money went into it, and how much it's valued today. That's the big piece that we really need to account for. But the ownership of the property, whether it's yours or his, isn't as important as whether or not it's protected. So if you were to just gift it today, there's no protections. So if your son tomorrow, God forbid, goes through a scenario where a creditor goes after him, your home that was in your name yesterday is now part of that litigation. And that's something that we always want to avoid and account for. And there's no real detriments to planning for the more complex scenarios, knowing that those protections are in place. Yes.
If she had a trust, then that house in the trust that it's going to go to the son, would that be
Yeah, exactly. So let's look at it this way. There's two scenarios. Either you make the gift while you're alive, or you wait until you pass to make the gift. Regardless, if you could create a trust today without having the property move in title or a name or anything like that, it's still associated to you and your social security number. If that property is in your living trust, which aptly named while you are alive, and it gets passed on to your son, it gets passed down in a new trust that has those protections. But if you make the gift or pass without that trust, then it falls into his estate. It's then calculated on his estate taxes and combined with all of his assets, and it doesn't offer those protections that you could have provided for him. Anything else? Perfect.
Okay. So we're going to get into some scenarios, just like what we were doing, but we put a couple case studies together. So Oleg's actually going to go through some of these with you to go where they were, what we were able to put in place, and where they ended up. So Oleg, will you please kick it off?
What I want to really emphasize here is the scenario isn't what matters. I want to give you a sense of what lens we use to evaluate client situations and individual investments and things like that on a case-by-case basis. So focus a little bit more on why it is I'm pointing certain things out rather than the investment types themselves. Today we're going to be talking about a real estate investor, 50 years old, net worth of $15 million between properties, cash, stocks, whatever the case. And is concerned about the high taxation that he might have to be subject to when he passes, and is also concerned about asset protection. So those, the accessibility points for creditors and risks and things like that. The main goals are to preserve wealth, reduce taxes, and protect the assets. The strategies that are used are business structuring. So to put it simply, is a property in your name? Because if it's in your name and someone slips and falls on that property, the lawsuit's also going to be in your name. If it's an LLC, there's a layer of protection, if it's a rental property in particular. In income-producing businesses, you have a company, you have employees, you make over $1 million in net profits a year. There are different types of structures that your business can have. You could have a corporation, you could have an LLC, you could have a partnership. Again, it could be fully in your name. What types of taxations are you being subjected to? And what kind of protections and layers are you being protected to? All of that is important to consider when looking at each individual piece as it fits into your life. Tax-efficient planning. This one gets a little bit tricky. So, you have large income producing vehicles, you have rental properties, you have employment income, you have business income. How much of that are you actually taking advantage of? How much of that can be protected? How many of the strategies that we've mentioned up until this point can you utilize, and in what combination? You can't use all of them. It wouldn't benefit you entirely to use one of them. How do you know? The reality is you really can't unless you have someone that's looking at the full picture. Executive bonus plans we've discussed, and then estate planning with trust. So we'll get a little bit more specific, even though we addressed a few of those examples just now. Is there a second slide after this? Yeah, perfect. So let's break this down a little bit. $15 million in net worth. Let's say some of that is in commercial real estate, some of that is in residential real estate, it's being rented. We want to look at it in terms of opportunity cost. It's not about this investment is good, this investment is bad. It's about how much of your energy, how much work is going into a specific investment versus how much of that equivalent return can you make with zero work, with zero attention, and with substantially less risk. How do we look at that? Each property has a cost, each property has a return, and each property, let's say in this scenario, has a mortgage. We would break that down and look at what is the true return that you would receive after all expenses, after all costs. In this scenario, the commercial properties, which tend to have a much more preferable return and a much more preferable growth, generally tend to fall above, let's say, a 5% threshold of return after you've reduced the expenses, after you've paid out all of the employees or anyone else at the management companies, and after you've paid the mortgage costs on it. So let's say all of those were cleared. All of those were above 5%. But then we get to a rental property. Rental property, 7% interest rate, given how high interest rates have been over the last few years, is receiving a rent that is suitable in the market. But once we look at the 25% that gets deducted by the management company, once we've paid that interest on the mortgage, all of a sudden we see that the rental property is actually only returning 3%. And that 3% is taxable. So the question is, how much of your energy is actually going into this to get a diminished return when you can get out of that property, take all of the net proceeds of that, put it into any bond going out a few years, and all of a sudden you're not making 3% and dedicating, a day of each of your week to focus on it. You're making 4%, and you don't even need to keep an eye on it. So one of the things that we were able to do for this client is identify weaknesses in the investments themselves. And this doesn't only apply to real estate. It applies to investment vehicles. It applies to stocks. It applies to specific bonds. When you're looking at it year to year, you may not notice that your return is below what the industry average should be. It's looking at it over the long term, measuring it against the risks, and measuring it against the energy that you're putting into it. And we do this on an ongoing basis, but that's really the bulk of how a financial plan starts. It's an evaluation of every key piece, identifying weaknesses, identifying risks, and identifying opportunities for improvement. And so in this case, we were able to flip one of these rental properties without having to worry too much about the taxation because it was relatively new, and then reinvest that money into a much more consistent and much less stressful investment type. Asset protection. There were other residential properties and rentals that were part of the portfolio. They passed the eye test of the net return. They made over the 5%. We didn't want to touch them, but they weren't protected. They weren't in an LLC. They didn't have that protective layer in the event that something happens. So putting those, really, really simple strategy, doesn't actually take much effort. Establishing an LLC, retitling the property into the LLC, the box is checked. In terms of long-term asset protection and how it pertains to the generational wealth transfer, $15 million today is exactly the type of net worth we're focusing on when we're talking about being concerned about death taxes. Because in 17 years, that amount's going to double, if not triple, considering what your investments actually are. But we know that even at a conservative growth rate, $15 million will be over that exemption amount at the time of passing in your 80s and 90s. How do we account for that today? We can utilize some gifting strategies if the residential properties or any of the businesses have that value or the beneficiaries want to be involved in that. In this scenario, the beneficiaries were less involved and the person was actually more on the charitable side. And they were more interested in the ways that we can utilize charitable gifting without losing any of the value of our assets today. There are certain trusts that allow us to defer out when that actual charitable gift is made, but take advantage of the taxable benefit of that gift while you are still working, while you are still alive. So you are able to structure in a way where you can get the tax deduction as if you made the gift, but the money is still technically in your ecosystem. It's still growing. You get a certain amount of annuitized return back to you, but the money that is left over at the end of your life is then what the charitable gift is. And there's inverses of that. You can make the gift today and the benefit would be at the end of your life, but that is one of the ways that, though intangible, is a way to give a charitable person opportunities and benefits outside of just the emotional and the spiritual value that they receive from making the gifts. And finally, as I mentioned, one of the strategies when it comes to high-interest businesses is rather than having clients spend money, though I will disclaim it is my favorite thing in the world to do, to tell my clients to spend more when they need to. You know, you worked for your money, you may as well use it and enjoy it. One of the ways to go around that is by kicking growth out of your estate and out of your name. There's a complex trust called an intentionally defective grants or annuity trust. You do not need to remember what that name is. That's what I'm for. That allows you to put a business into a trust. And the intentionally defective part is once the income comes out of it, it is deposited into a trust outside of your name and outside of your ecosystem for the benefit of your beneficiaries. So a $5 million property that generates, let's say, 10%, $500,000 a year that would otherwise be added into your estate can be kicked out of it. So you basically plug the growth while still retaining all of the true value in your multi-generational family. You lock in that 5% on the property and the business, that valuation stays, all of the income gets shot out, and all of a sudden that $500,000 that's being contributed into that out-of-estate trust every year, that grows. It's still taxable, but it grows up until, whatever that is invested in, it gets contributed to. And at the end of your life, rather than having, let's call it a random number, 30 million additional in your estate, you suddenly have 25 million, which is all of that growth and all of those contributions out of it. That is not subject to estate taxation. That is not subject to creditors. That is a totally protected investment and entity for the benefit of your beneficiaries, to which they have access to once you pass. By combining all of those strategies, by looking at all of those pieces and planning ahead, knowing that things will change, we create a foundation where when those changes happen, we either no longer need to worry about them, or we've already created a way for us to pivot in a way that is suitable and safe and comfortable to you as the end client. Go ahead, Chin. And while the taxes saved are somewhat intangible because we don't know what's going to happen to the investments over that time, what we do know is we have saved roughly 40 to 50% of whatever would exceed that $23 million amount, which, it could be anywhere from you went over by $1, whatever, maybe you didn't need to plan for it, but it's good that you did. You still have the protections. You went over by $10 million, that's roughly $4 to $5 million saved that would otherwise have gone to the government. That covers the comprehensive estate planning. risk management and asset protection is really the bread and butter of financial planning. It's identifying what your risks are and could be and addressing them ahead of time before they become real risks. And the personalized investment management piece, that's really where your goals, your intentions, and your comfort levels come into play. Because the most important part is that you are comfortable, that you feel safe, and that you can be confident that your legacy is going to be secure and protected. And, as it pertains to businesses, we've already covered that ad nauseum. You understand that businesses have their own risks that get addressed in different ways.